July kicked off a blockbuster earnings season once again to push global equities to all-time highs, while Chinese regulators moved dramatically to shift the playing field in EM equities in the month. Focusing first on earnings, during the reporting seasons in the first, second, and now the third quarter of the year, investors have realized more than 3/4 of the 17% return seen in global equities to date. Outside of the results seasons, however, investors have generated a paltry 3% return, suggesting that as this earnings season comes to an end, more modest return prospects are on the horizon in the weeks ahead. Indeed, two catalysts may prompt a pause in the current market rally. First, in late August, the U.S. Federal Reserve is set to announce its roadmap, slowing the bond buying it began at the height of the global pandemic. Secondly, in late September, the U.S. Congress may finalize the next stage of its fiscal program, which looks set to increase corporate tax rates in 2022. With 2022 U.S. earnings expectations currently at 10%, a rise in taxes will likely eat into the main driver for equity investors in the year ahead. As a result, having benefited from the strong recovery in cyclical earnings, we're continuing the rotation to focus on high-quality and high-visibility earnings streams looking ahead, as the economic cycle matures into the mini-cycle phase outlined in July. A more cloudy outlook has emerged for China as regulatory actions have become a significant negative catalyst for risky assets. Fortunately, we'd been reducing exposure to risky Chinese credit and Chinese equities in recent months, as we had become disappointed with the balance being struck between reform and reflation and growth. Despite the sharp falls, we recognize that Chinese equity markets may still yet need to price a derating in medium-term growth prospects, especially in segments targeted by national reform efforts. For bond investors, our focus on risk management in the fixed income arena remains. With U.S. 10-year yields having fallen below 1.2% in early August, we have once again exited our tactical holdings in long-duration government bonds. Indeed, with the upcoming Fed announcement and a new fiscal stimulus on the horizon, we expect a move back towards 2% in 10-year yields in the months ahead. For more information about other steps we're taking to prepare as the economy transitions into a mini-cycle phase, please visit us on ubp.com.